One of the most common questions I get asked all the time is, should I invest now or hold my money and wait? And I can't really blame you. When we look at the performance of the S&P 500, the top 500 companies in America, many fear that the dip we've seen so far is just the start of a much bigger landslide to come. So let's talk about what's to come, and I'll tell you why I'm also currently holding over 100,000 in cash and show you an example of something quite drastic that happened to me that might just change your mind. Now at this point we're nearly halfway through the year, and so far the S&P 500 has been doing pretty well, up around almost 8%, and over the past year almost 5%. Of course, the rise this year has been a damn sight better than August to October last year when the markets took a nosedive. The reason you should actually be really interested in this is whatever you are invested in, the S&P 500 will have the biggest impact on your portfolio. It makes up around 50 to 60% of most broad index funds, and even if you're invested primarily in UK stocks, it will feel the hit from the USA as most of them trade with the USA, and there's a fear of the markets. It won't hit the UK quite as hard, but it will still hurt, so it's definitely worth paying attention to. Now this feeling of uncertainty I think comes from two places. The first is if you've been invested in index funds, which are classed as the safest form of investment. Over the past 18 months there's a good chance your investments are likely either negative or at the best break even. Whether you're invested directly in the S&P 500 or a broader index fund like the Vanguard All World Fund, which has fared slightly better out of the two. To give you some context, here's my Vanguard Developed World Fund, which I started back in April 2022. You can see I took a brief pause where I decided to hold cash while the market actually rose, but then fell again. But even so, that investment's performance over the last 13 months has been minus 2.5%. Comparing that with my cash balance, which has a similar amount invested in it, and its gain has been 5.68% in value over the same time period. So it's no wonder when we've been in an 18-month period of decline or not really getting anywhere, you start thinking, am I better off just keeping it in cash? Especially as the Bank of England keeps increasing their rate, and so the interest rates that banks are willing to pay you will keep going up and up. Of course, that still doesn't beat inflation, which is currently 10%, but 4.5% compared to minus 2.5% sure does feel quite appealing. The second place this feeling comes from is the sheer height of the market and a lot of the looming fear about the market going to crash. And there's a couple of things you need to understand here. The first is crashes are a completely normal part of the stock market. In fact, since 1929, there's been at least 13 notable crashes to date, and the latest real big one being the 2020 COVID crash. If you're investing for the long term, which you should be, there's no avoiding it, and it's important that you buy even when it's crashing. Everyone wants to buy when things are going up, but no one wants to buy when it's down. And that's the time you're really going to make the most money. Think of it like a sale. You're able to buy the same investments at a much cheaper price. The other thing is, people claim to predict the stock market crash every day of the week. Michael Burry, the famous investor who rose to fame when he predicted the housing collapse of the US housing bubble before 2008, warned that the US economy is likely to enter recession later this year, and told people not to invest. He's since then actually admitted that he was wrong in telling people not to invest. Unless you are Mystic Meg and have a crystal ball, nobody knows what's going to happen for certain. What's crazy is if you say every day that the market's going to crash, when it does crash, you can pat yourself on the back and say that you predicted it. But even with all that being said, where are we today and what are we looking at for the rest of the year? The stock market has been like a roller coaster for the past year, with two big factors driving its ups and downs: inflation and the rate hikes by the Fed to try and get inflation under control. These issues are still the talk of the town in May, but the end of this saga could be just around the corner. In March, the Consumer Price Index, which is a measure of the average change of prices in goods and services, went up 5% from the previous year. That's a bit lower than the highest point we hit in June 2022, but it's still much higher than the Federal Reserve's target of 2%. It's like a balloon that's slowly deflating, but it's flying way higher than it should be. The stock market had a boost at the end of April when news came out that the economy was growing slower than expected. The GDP had only grown 1.1% in the first quarter instead of the predicted 2%. Investors thought that this news might mean that the government might not raise interest rates as much as planned. But don't get too comfortable, because some experts think that the government will raise rates again in June. The latest data on inflation suggests that we're not out of the woodwork just yet, and a storm is still looming. Despite some hopes for a break, the bond market market is predicting an 85% chance that the government will raise rates by a little bit in May and a 28% chance they'll do it again in June. The Federal Reserve is trying to balance the economy and prevent a recession by fighting against inflation. The housing market and the manufacturing activity have both slowed, and the yield curve has been inverted since mid-2022, which could be a sign of recession. The yield curve is a line graph that shows a difference between interest rates for different types of bonds with different maturity dates. However, the labour market is still strong, with 236,000 new jobs added in March and a low employment rate of just 3.5%. Despite this, experts think that recession in 2023 is unavoidable and that high interest rates will make it worse. An interesting assessment of the situation was by Jake Jolly, head of investment analysis at BNY Mellon Investment Management, who manage over $2.4 trillion for their clients each year. Every year, they take a look at the market and debate different scenarios and outcomes for that market. And here is what they came up with. Scenario 1, the credit crunch, a 50% probability. This certainly isn't the best option. This imagines what would happen if the Federal Reserve hikes interest rates 2 or even 3 more times, as the banking turmoil in the United States and Europe caused credit conditions to tighten significantly. This would catapult the United States into recession during the second half of 2023, and Europe and the UK will feel it even earlier. The labour market would loosen quickly and layoffs would be widespread. He said if the US sneezes, the whole world will catch a cold. Scenario 2 was a delayed landing with a 30% probability. In this scenario, key global central banks pause their rate hikes in response to the banking crisis. Labour markets remain exceptionally tight and wage growth re-accelerates, which will add to sticky inflation levels. China's reopening, meanwhile, ends up being inflationary for core goods. As inflation grows again, central banks are forced to hike rates even more, sending the United States into recession in the second half of 2024. The best and most ideal scenario would be scenario number 3, a soft landing, which has a 20% probability. This would be the ideal and, according to Jolly, the least likely scenario. Inflation continues to fall without much need for Fed tightening, and interest rates peak at 5%. Job loss is minimal as wage growth decelerates alongside inflation, and China's reopening has positive spillover effects and is, on balance, disinflationary for core goods. In any of these scenarios, it's likely the outcome is going to be negative over the next 18 months. What's really interesting is the more you read about the recession and analysts' opinions, the more you convince yourself that it's right. When I look back at my investing journey over the past 10 years, one of the biggest mistakes I made was listening to people's opinions and worrying about it crashing. Here's the S&P 500, and all through this time period, I didn't buy the S&P 500 because it looked too expensive or too high. I also didn't bother buying companies I liked, like Microsoft, Tesla, Apple, or Netflix. Okay, Netflix are not quite as hot as they used to be, but you get the gist. Sometimes your mind is your own worst enemy, and thinking purely logically doesn't always work. Remember, a lot of the time the stock market is perceived value, so although something might look expensive and overvalued on paper, people will still buy it. It's like designer clothes you know you can buy for £10 in Primark, but people will still pay £100 for it because it's got a designer label on it. So what do I think you should do? Invest now or wait? Now I know what you're thinking, and you are about to comment, timing the market is better than timing the market. Did I get that right? If you draw a straight line across the progress of the world funds or the S&P 500, it's always gone up eventually. And the dips fade away into nothing and are just a blip on a much greater timeline. And I do completely agree with this. Invest, set and forget, which I always preach. But there's a couple of things you need to get right before you do that. First, when do you need the cash? If the market dips and doesn't go anywhere for the next 3 to 5 years, are you bothered, and can you afford to leave that money in and just forget about it? The cost of living continues to creep up, so you should have an emergency fund, as well as be able to afford your lifestyle costs going up by at least another couple £100. If you're saving for a house in the short term, you're also probably going to be better off with a fixed cash interest. Secondly, and I know you'll be shaking your head, you should time the market. Okay, bear with me. Now let's look at the FTSE 100 as an example, and this pretty much happened all around the world. Looking at this chart from the past 5 years, can you guess when I invested £20,000 into the FTSE? Yep, right here. Now, if I would have just lump summed it in like people tell you, but with all of my money in one go, I would have had to wait 3 years later just to get my money back. Luckily, I've learnt from experience and still had a ton of cash to invest. So I bought here, and more along the way. So I was actually able to make money through the whole situation because I bought as the market went down. People will debate this non-stop, and sure, because I didn't plan to take out the money for the next 20 years anyway, it didn't really matter. Now, I don't know about you, but I would have much preferred to have done what I did than just put everything in at once. And I admit this is quite an extreme example, but what I suggest is not to put everything in at once. If you have a larger sum to invest, you can invest in larger chunks, but spread it out. And equally, I think you should have a plan to invest on a regular basis, at least a certain amount. Pick an amount you can afford each month and then set up a direct debit, and then you can do the set and forget approach. Having done it a couple of times, lumping everything in and watching it go to nothing for a year doesn't feel great. And also a huge plus, and what I've seen from my latest portfolio, is adding each month to your portfolio makes it feel like your portfolio is continually going up and up, even when the return on investment may not seem so, which is quite a weird psychological trick, but at least for me it feels much more positive. I also have what some may consider is quite a strange approach, especially with my pension, for example, which is at 50,000 roughly right now. Gaining 10% a year at this stage isn't massively important. Although £5,000 extra would be nice, I'm focused on just getting as much money in there as possible, ASAP. So then when I get to 100,000 and the market has a good 20% year, I'll make 20,000. Or on a 300,000 portfolio, that would be 60,000. That for me is when the portfolio will really feel much more exciting and you see that rapid growth. So at the moment, I'm just looking to build it up as quickly as possible. And if you're thinking, well, if that's the case, why would you keep 100,000 in cash? Why not just invest it and get a much better return? Well, the money is for a property purchase, which I'm hoping to make in the next 6 to 12 months. So I've split the money between 50,000 in premium bonds and the rest in a high interest savings account. And that's because I'm now at the limit for how much interest I can earn without paying tax. I need to be smart about what I'm doing with the money, or I'm going to be liable to pay tax on the interest. Yay! So the answer, in my view, is invest now, but have a sensible strategy in place so you don't get yourself stuck and end up waiting around for everything to come back up, which isn't a great place to be in, trust me. Let me know what your strategy is going forward and your views on the whole situation in the comments. And if you want to avoid an investing mistake that could cost you nearly £400,000, be sure to watch this video right here. Thanks.